Are you looking to make a major expense this year, whether it is putting a new roof on your house, buying a new car, or trying to put one of your kids through college because God knows that's so expensive right now? And whatever that major expense is, a clear option to affording that is using a home equity line of credit. For those of you that do not know, a home equity line of credit is an amazing tool to use to either restructure or pay off your existing debt, fund major purchases, or it's just used as an easy way to access capital in case of an emergency. But please listen when I say only if used correctly. I personally have a home equity line of credit that I use just for major purposes for my rental real estate portfolio. And while I hate to admit it, when I first got my HELOC, I didn't really know what I was getting myself into. And had I know what I know now about a home equity line of credit, I may not have gone that option. And if I were you, I'd really stick around to listen to the cons of using a HELOC for major purchases, because some of these you may not even think about. All right, but first things first, moving on to pro number one, which is you have lower interest rates and you have an interest-only period to pay back. Now, what I mean by that is a home equity line of credit is typically structured in an interest-only period and a repayment period to where you pay back the principal and interest. So for mine specifically, I have 10 years where I can draw from the home equity line of credit and pay interest-only payments back, pay it back in full if I would like, and then reuse it. It's a recycling line of credit. And then after that 10 years ends, if I have a balance, that's when I'll start paying principal and interest in the repayment period for the next 10 years, and I cannot draw from them. I just pay back in form of a loan. But getting back to the interest rates, as of this month of recording, the average credit card interest rate is about 22%, which is absurd. So if you're thinking about putting your major expense on a credit card, you're going to be paying a lot in interest. Now, with a home equity line of credit, the average interest rate ranges between 8 and 11%. To put that into context, if you were going to put a new roof on your house and it was costing about $15,000, that's a difference of $110 a month over a 5-year payback period. And that's $6,600 total that you'll be paying more if you were to use a credit card over a home equity line of credit with the lower interest rate. Which leads us right into pro number two, which is the flexibility of a home equity line of credit. The great thing is once you apply for it, once you get one, you don't have to use it at all if you don't want to. It's just there in case of an emergency. It's simply used as a credit card to where if you don't swipe, you don't have to pay. But when I say flexibility, I mean that in two ways. The first being the flexibility of repaying back the loan. Now, like I said, the interest-only payment is the first 5 to 10 years, whatever your home equity line of credit is set up for, but you only have to pay interest-only payments. So, for example, when I took out my $25,000 HELOC, I used it all at one time and since then paid it off, but it was only $160 a month for using that $25,000. The great thing was I was able to pay back the interest plus put a bunch of lump sums into the principal to pay that back so much faster. The second way I mean flexibility is the accessibility to the money. It's so simple. They give you a checkbook basically, and all you have to do is write a check, and it's that simple. So let's say the contractor's finished up on that roof and you need to pay them their invoice. All you would have to do is stroke the check from your home equity line of credit and give it straight to them, and it's done for and paid for. Now, the third pro is the cost to even getting one. It is so cheap to get a home equity line of credit. I know people that have a $150,000 home equity line of credit. I personally have a lower one, which is $25,000. But the cost of getting one of these is so cheap. I was actually in the bank yesterday talking to them about their HELOC products because I'm looking to refinance mine, and they said that they're offering $2,000 to closing costs, which would cover all the closing costs, for a home equity line of credit. The only out-of-pocket expense you would have to pay is your appraisal fee, which ranges between $500 and $1,000. So you're telling me that for $500 to $1,000, you could get a home equity line of credit for, let's say, $50,000 and just have it there for an emergency or for one of these larger purchases. That is an amazing cost to have access to that much money. But I'll be saying but a lot. But like I said earlier in this video, only if you use it correctly and you know how to manage your money. If you give this type of money to someone that can't handle money, it's going to end very badly. And that is a perfect transition to con number 1 of using a home equity line of credit for a major expense, which is the bank can foreclose on your property if you do not pay back, right? If you don't pay, you can't stay. It is a lien on your property, and so it goes second right behind your mortgage. So if that does not get paid, they will ultimately take over your property, sell it, and retrieve the funds that's owed to them. So when applying for a home equity line of credit, if you bite off more than you can chew, you're going to be in between a house and a hard place. Remember earlier when I said that I wasn't fully aware of what I was getting myself into? Well, I didn't really focus on anything but the amount that I was able to pull out as a home equity line of credit. I didn't worry about the payments, didn't worry about the interest rates, and had I not been able to pay that or be in a position to pay that, then it could have ended very badly. It's so important to know exactly your costs and what you're getting yourself into. So before you even get the home equity line of credit, make sure you figure out all of the details, the interest rates, the term of the home equity line of credit, how long you're in the draw period and how long you're in the repayment period, how high your variable interest rate can go, and what the amount of your payment will be. I made a knucklehead mistake and I don't want to see you do that as well. And depending on your risk level, you may think, okay, this is not the route I want to go. I don't want to risk my house. But I feel very comfortable knowing that that $25,000 HELOC that I have, if I were to take that out and lose it, I would be okay. It would suck, but I would be okay and be able to pay that back. You need to be honest with yourself and you need to see if you're comfortable in that situation as well. Con number 2 is the potential for overspending. You know, when you got approved for your house and you talked to the lender and the lender said, hey, Tom, you're approved for a $500,000 house. And you thought to yourself, that's amazing. But once you looked at the numbers associated with that type of purchase price, the principal, taxes, insurance, what your monthly expenses were going to be, you just couldn't wrap your head around having that monthly payment because it was so high. Well, my wife and I are actually in that position right now. And this is when the rule of just because you can afford it doesn't mean you should rule comes in. Just because the bank said we will give you up to a $100,000 home equity line of credit on your property doesn't mean you should necessarily take them up on that offer. Like I mentioned earlier, run the numbers, see what the interest rates will be, and make sure you are comfortable with the end-all be-all number, worst case scenario, just in case something were to go wrong. This is when you have to be extremely honest with yourself and see, do I honestly manage my money well? Or if I had that type of money, $100,000 just sitting there, would I just take from it a little here, a little there, and ultimately it would add up to a lot of debt. Now, leading on to con number 3, which you probably weren't even thinking about before this video, but the impact of future borrowing. Now, depending on the amount of your major expense that you're looking to borrow, that could determine you being able to refinance your house in the future, purchase a new car, get new loans. So you'll want to be very careful and plan ahead for your future borrowing. And one thing that I learned recently is that HELOC lenders can actually refuse your right to refinance your property, meaning they want to be paid first before you go through with your refinance on your property if that's something that you were looking to do in the future. So if you have a balance, you would have to pay that off before even refinancing. Now, I've never been in this situation, but if you're someone that's looking to improve their house, to refinance, cash out, and pay off your HELOC, or someone that's just looking to get a new loan in the future, you want to make sure your debt to income ratio isn't too high for that because of the amount you've taken out on your HELOC. Read the fine print, ask a ton of questions. Now, if you're still with me and are considering still getting a home equity line of credit, I didn't scare you off yet. Well, you want to make sure to do these next 3 steps before even getting your home equity line of credit. And this is crucial. This is something that I wish I did before getting my home equity line of credit. Now, the first thing is creating a budget. And I know what you're thinking, Evan, why are you treating me like a teenager? I know how to manage my money. But honestly, I've been doing this for about 5 years, and this is I think the best thing that I've ever done for the health of my finances. And no, don't do it in your head. Make sure to put the pen to paper or create a spreadsheet if that makes you feel more comfortable. But being able to know exactly what comes in each month and what goes out is huge in determining how to cut some costs. Some things will come up that you don't even know you're spending money on, which is huge. And you'll be able to know if you can actually afford a home equity line of credit payment right now. Now, the second is go to multiple banks and see how their home equity line of credit program is set up. You want to make sure you look at all of the loan to values, your interest rates, the interest rate caps, and the terms of the repayment period, as well as the draw period. You just want to make sure you find a bank that fits your needs and you feel most comfortable with. And lastly, you need to know exactly how home equity line of credit payments work. And in order for you to do that, you need to watch this video next, which goes over exactly that. I will see you guys in the next one. Peace.